Welcome to the Daily Update. This is Being Prepared Monday, May 2nd, where we'll look at the action in the market today and then see how things look for Tuesday, May 3rd. And after a pretty rough start at the open, we ended up having a rebound and finished actually up on the day. The big question now is, can this continue? Or are we just wearing off more of a short-term oversold condition before we get ready to go lower? So let's go back over and talk about what happened on Monday. Right at the open, we did have a lower open. And then right after things opened, there was a bounce that took us back to the daily pivot, just below the daily pivot at about 41.75. As the day went on, we saw renewed selling, and it took us below the unchanged level at about 42.15. Then there was continued selling that took us down below S1 at 40.81. So it's like, here we go again. Everything's turning negative. But we saw some late day buying as we got closer to the close that took prices back positive, and it actually changed the tone of the day. Now, you can attribute this to many different things. We had gone down pretty far, pretty fast. You have some short-term position traders who probably saw an opportunity. There were some oversold conditions. And when you combine enough traders together, that ended up turning things around and actually making things end positive. Right at the close, we closed at the later day high, but below the daily high. And I think that'll make a little more sense. We set the high early, right after the open. Well, we almost came back to that level near the close, but we didn't quite get to that level. And hopefully this will make more sense when I'm able to show you the chart. We ended up being up 0.57%. Nothing really all that amazing. The more positive aspect is that we saw the change in tone as the day went on. Volume was above average. And what we're looking at now is the technicals do remain negative. And the bounce that we saw could be just wearing off the short-term oversold condition. The big talk is inflation and interest rates. We have the FOMC getting ready to meet, and they'll release their decision on Wednesday at about 2 p.m. And then after that, they'll make a statement, and then there'll be a press conference, and you can expect things to just kind of go a little crazy there for a while. The geopolitical concerns that we're still dealing with right now, and I'll list those more later. Earnings continue to come out, whether they provide a positive backdrop or a negative backdrop, who knows from one to the next. So, to go through what we can say about the day, the technicals do remain negative. The late day rebound after being down, we bounced from being down 1.7% to finish up about 0.5%. So that's a pretty healthy move. Interest rates continue to advance. The 10-year yield did hit 3%, but at least according to my chart, it settled at 2.99. I looked at another piece of information that said it settled at 3. Take your pick. We were short-term oversold, and we saw a bounce from that. But as I asked at the beginning, can that continue? But we've asked that before. Are we going to get fooled into thinking something real is developing here? Or are we just wearing off or slowing things down a little bit before we get set to go lower? The equity put-call ratio is still quite high. It's dropped from where it was, but it's still pretty high overall, showing that there's a lot of fear. The long-term support level that I'll show you on the chart, it did hold right at about 40.62. The S&P continues to be in correction territory. The 10 to the 5 yield curve remains inverted. And again, you may discount that and not think that's very important. But I do, and I'm just kind of waiting. Plus, there's some time lag. If we're going to get a bounce out of this from the time the yield curve goes back to being normal until we see stocks really start to take off. If you try to time that and we drop lower, what happens if we go back inverted again? Then you might be seeing significant losses. Personally, I like to see other forms of confirmation before we potentially could see that big rise up. The economic reports that came out, we had the ISM manufacturing index. It decreased to 55.4%. They expected 57.9, so that came in much lower than expected. And the last time we got this report, it was at 57.1. We also received the total construction spending, and it increased 0.1% month over month, but they expected that to be a lot higher at 0.8%. And then the previous time we received this report, we saw an increase of 0.5%. Our trend is negative, but with the up day, I've switched the bias back to being positive. And it's not so much because we were up 0.57%. It's because of the late day rebound and how things seem to shift as the day went on. But our momentum is still negative, and that's looking out 2, 3, 4, 5 days. Here's another new chart that I'm just starting to include with the videos. Yes, we focus on the S&P 500, but it's also good to keep an eye on what are the other indexes doing. And this is year to date. That's what the YTD is. And so far this year, for 2022, the Dow is down 9%, or the S&P from the beginning of the year. That's a little different than how I calculate it. I calculate it from the high on a closing basis. Well, since the beginning of the year, the S&P is down 12.8%. The Russell, which are the small caps, they're down 16.1%, and the NASDAQ is down 19.9%. Usually, between 0 and 10 is just considered a pullback. Between 10 and 20%, that's considered a correction. If we go over 20%, most people consider that to be a bear market. And we floated in and out of the bear market territory with the small caps and with the NASDAQ. But now we're bouncing around. Just because we hit that level doesn't mean it's magic. We can always come back. Or we could see things rebound a little bit and then head lower and then really get into a full-blown bear market that lasts. So let's go back and look at the day's session. First, let's look at sentiment and this chart seems different all the time. It says the previous close was 30 and this is 30. Who knows? But right now, we're just above extreme fear. And here's the longer-term view of that chart. When we drop down below 25, that's when we're seeing more capitulation-type fear, like what we saw in about the middle of March. Looking at the VIX, it actually declined because we had an up day. The bar chart showed that we really spiked up. And I'm having a lot of trouble. I'd like to use a mouse and a highlighter and maybe a magnifier on here, but I'm having a lot of trouble moving the mouse as I record these videos, and it looks pretty schizophrenica. So I'm not sure what to do about that. I've tried a couple of different things that don't seem to work. Anyway, the bar chart really spiked up, but we closed well off of the high with the VIX, and we actually declined on a closing basis. Then looking at the VIX with the RSI, where we had been extreme positive after Friday, well, we wore off some of that condition on Monday. Then the Ulcer Index continues to go up. That just shows there's an increase in fear overall, even with the advance that we saw. The equity put call ratio is still pretty high, but you see we're well off the highs of where we were. And I'm also trying to add some more annotations to the charts as I come across them. Here's a 5-period simple moving average of the equity put call ratio, where we're still pretty high. We came down a little bit after Friday. Well, we bounced back up slightly on Monday. Here's one of the Isabelnet charts, and I hope I'm pronouncing that right. I find their charts kind of interesting. And so as I see them and as I see that they might be interesting to you, I'll go ahead and include them as part of the video and go over this. This is the net bullish sentiment, both retail, that's you and me, people that buy through a broker, and institutional together. Those are the big boys. Those are the banks and the retirement funds and the big guys. It's taking those together against the S&P 500. How do they feel? Well, way over here on the right-hand side, when you combine the two together, we're down at 18.5%. And this is considered to be an extreme negative reading. This blue line right here is the S&P 500, and you can kind of see how things have happened at different times and how the S&P has reacted to that. So feel free to pause this and kind of look this over. There's a lot of things happening on this chart. Another chart also shows sentiment, where this, again, looks at retail, institutional, and even foreign investors and how they've switched over the past 12 months. And when this gets extreme negative, like it is now, we use that as a contrary indicator. And Goldman Sachs, I believe, puts this out. So this kind of goes hand in hand with seeing some extreme fear right now. Here's another chart just showing some seasonality and the average returns going all the way back to 1928. And this blue bar right here, this just shows that we've been averaging about 1.41%. So usually April is a fairly good performing month when you look at it on a historical basis. Some people put a lot of weight into this, and there's some real merit to be said for that. However, personally, I have trouble when I look at statistics and it says, okay, 75% out of 100 times or 100%, this is what happens. Well, okay, that really doesn't help me because there's still 25% of the time when that doesn't happen. And so I know that for asset allocation, and I know we're playing probabilities with everything, I don't really buy into that. Now, you may disagree with that, and we can talk about it, but I just think, okay, this is what quite often happens, but every year it's a little bit different. And so we have to take things for what they are right now, evaluate them, and then make our decisions that way. But we can use history to help let us see what has happened. That's why you don't see me doing a lot of, well, how does this period right now look to 2009 or back to 2000 or, oh, here it's looking similar to 1938 or something. And then they're trying to match the chart patterns together. I've watched a lot of those folks, and they do a tremendous amount of work, and they provide some interesting insight. I don't necessarily follow up myself. I pay attention to that, and I watch for it, and I make it part of my overall evaluation of things, but I don't do a lot of research or implementation of that research myself. Then also looking at the S&P 500 level and EPS, earnings per share. This is where we're currently at right now when this chart was made, and Goldman Sachs put this out. They're expecting the estimate for 2022 for the S&P to eventually get to 4,700. Well, here are the adjusted EPS forecast. Now, again, these are forecasts, so they can change. And you'll notice as the market goes up, the estimates tend to go up. As the market goes down, the estimates go down. And so, again, we just kind of have to take this for what it is. But they are expecting the estimate for 2022 to rise from 209 up to 221, and then in 2023 to rise to 233. And that's what these folks need to do. They need to find good information so that people will want to buy stocks, because the value of these stocks, not only on a price basis, but for the reason why we own them, should also be going up at the same time. Another thing I wanted to point out is, I haven't brought this chart up in a long time, but copper. And some people might say, well, that's old-fashioned. We're based on silicon now. But copper is a huge part of the economy. A lot of times when we see copper going up, especially when the markets are going down or the economy is really struggling, that can be an early signal. It's kind of like a leading indicator. They call it Dr. Copper. Well, we really haven't been doing all that much for most of 2021. But I just brought this up because we are still positive. The blue line is above the red line, but we're dropping out of this range and more down into the bottom part of this. So I just wanted to bring this up for you to be aware of that. Looking at the sectors, we're spread across the board. Communication, energy, and tech. Some of the ones that got really hit on Friday, they were up. With discretionary, that's been just getting pummeled so far this year. Some of the negative ones, real estate, staples, utilities, healthcare, some of the different sectors that have been holding up better. They ended up being down on the day. And this just goes back to the all-time high, showing where energy is doing the best. We're seeing some weakness right now in utilities, and they're losing some of the edge that they did have before, where at the other end, communication, discretionary, and tech, those are the growth areas, and those are the ones that are having some problems. As far as the Fed watch, at the meeting coming up on Wednesday, there's a 97.1% chance that we will be at 0.75% to 1%. And here's the historical chart. Then in June, there's an 88.8% chance that we'll be 1.5 to 1 3/4 after that meeting. Here's the historical chart. Then at the July 27th meeting, there's an 82.7% chance that we'll be at 2% to 2.25% after that meeting. And remember, it's a range. They may set the target like they did last time at 25 or 0.25 or 25 basis points or 0.25%, whatever you want to call it. But really, there's a range. They're just stating the low end of that range, and it's usually 0.25% that is the range. And here is the historical chart that looks kind of messy. Okay, technical alerts. We had some positive and some negative, where the NASDAQ ended up setting a 52-week low. A lot of growth stocks in there have been having a lot of trouble. And a lot of these were set early in the day. The Dow was able to get back above 33,000. A lot of different sectors. The NASDAQ kept going down. I'm looking for S&P. It crossed below 4,100. And let's see. The NASDAQ was able to get back above 12.5. Oil went above 105. Gold went back below 190. Okay, let's look at the intraday, where we did have a lower open. It wasn't really a gap, but we were sure negative right out of the gate. And you probably had a lot of people over the weekend that were going, oh my gosh, and they watched a few of their financial shows and decided, okay, I'm going to get onto my brokerage account and sell at the open on Monday. Well, that took us lower right at the beginning. Right after that happened, we were able to bounce back up, get positive. And then here's the daily pivot. We weren't quite able to get back up to that level. And this was the high of the day. We trailed off. We went negative again and kind of danced slightly negative for a while. Then it looked like, okay, here we go. We're really heading lower. We went down to S1, fell below S1, but some support came in. And this is where everything changed later in the day. And this is a pretty nice bounce. Took us back positive, and we closed, at least in this run, we closed at the high of the run, but not the high of the day. This is another interesting thing. We did drop down to this long-term support level, and this line has been on this chart for a long time. And for us to come down to that level and bounce back off it could be seen as positive. And then down below here, we have where volume was above average. We're down 13.37% currently from the all-time high. Then I'm trying to switch some things around. I hope you like this. If you don't, I'll see if I even like doing it this way. But going back over, what are the things that are showing strength? What are those things that are outperforming? Value is outperforming growth. Growth is outperforming bonds. So that just shows you how terrible bond prices are these days. The 10-year yield interest rate, which is right up around 3%, that's outperforming tech and the S&P. The low volatility stocks continue to outperform the S&P. Energy is outperforming the S&P. Energy is outperforming tech, which is having a lot of trouble right now. The CRB index, which measures inflation, it continues to outperform the S&P. Gold continues to outperform the S&P. Staples, the things that you have to have, is outperforming discretionary, the luxury items that you don't necessarily have to have. And then junk bonds, because of the higher yield, are outperforming treasury bonds. Now, this is based on price. Now, some of the positive things that we can take from that. Energy is positive. Commodities are positive. Gold is positive. Interest rates are positive. That means they're all going up. Staples are positive. So, what's underperforming right now? The NASDAQ 100, the big growth stocks, are underperforming the S&P. The S&P 500 is underperforming interest rates. Growth is underperforming value. Tech is underperforming interest rates and the S&P. The S&P is underperforming commodities. The S&P 100 is underperforming the S&P 500. So the 100 biggest stocks in the S&P 500 are not doing as well as the other 405 stocks or so. Discretionary is underperforming staples. Now, looking at some negative things, the Dow Jones Composite is negative. The world indexes continue to decline. Junk bonds are outperforming treasury bonds, but junk bonds are also negative. They're in a negative trend right now. So that just shows you how much damage is being done to bonds. The FANG index is negative. Small caps are negative. The Dow, mid caps, NASDAQ 100, NYSE, the All Stocks ETF, which are U.S. stocks and world stocks. ARK, even though it had a good day on Monday, it's still down overall. Bitcoin is still in a downtrend, at least based on the chart that I use. The Wilshire broad-based index, the world indexes looking across the globe, and corporate bond prices continue to be negative. So this just gives you a list kind of in a nutshell of those things that are not doing very well these days. Now, this is a new thing that I did, and I'm not very graphically talented, so this is about as good as it gets for me. But there were so many negative things on the S&P, the list just goes on and on and on. And so what I tried to do is break them down into those indicators that fit all time frames. Over here on the left, we are below all the moving averages. The moving averages themselves are declining, and the advanced decline line studies are negative. And our different charts, the Heikin-Ashi, the Kagi, the Renko, the point and figure, blah, 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 all of those are negative right now. So those fit all the time frames. And yeah, there's some overlap here on this. It's not cut and dry about which category they belong to as far as the time frame. The short term, and the reason this is kind of a gold color is that means we are extreme negative. So I'm trying to give you some idea just based on what I'm saying of where we're at with things. The force index is negative and not extreme, where the stochastic RSI and the Williams percent are, they're red because they now have officially given us an oversold reading. They bounced into extreme territory, and after Monday's bounced out of extreme negative territory. Intermediate term still tends to be negative overall. The PMOs, based on the percent of the PMOs that are rising, those that are giving buy signals, they're extreme negative right now. The PMOs that are above zero is declining. Our momentum indicators, the whole list of all the different momentum indicators that we use, they're all negative. The parabolic SAR is negative. The stochastics, short, intermediate, and long term, they're starting to give us extreme negative readings. The 50-period moving average, that's also giving us an extreme negative reading. New highs and new lows are negative. The BPI, the bullish percent index, the CCI based on 14 and 20, the Chaikin money flow, the ease of movement, the money flow index, the ultimate oscillator, vortex, summation index, accumulation distribution, the itchy cloud, all of those are negative and not necessarily extreme, but they are declining. The boom indicator based on 50 periods, that is extreme negative. And these ones that have little colors on them, I will show you charts of these. The percent B is not extreme, but is negative, and the RSI based on 9 and 14 continues to be negative. Long term, the special K is going down. The rate of change going back 200 periods is declining. And the long-term trend, meaning that we're below the 200-day simple moving average, that continues to decline. When I switch over to things that are positive, what's looking good? The list is pretty short right now. This is all I could find right now. We have the Swindlin Trading Oscillator, which was up on Friday and was actually up again on Monday. And the Chaikin Oscillator is also starting to turn and go up, but it's a very short list. Then the different setups, and I'm trying to change different ways of how I approach this. We have the Copic curve, which is none of these are giving us a signal yet. We're just waiting to see if they do give us a signal. The mass index, the Pring bottom fissure, the small caps ratio to the S&P 500. And then when we see a spike in that can give us a thrust in the S&P. The positive backdrop after we have an inverted yield curve. I'm just waiting to see if any of these will happen. They're not really developing right now. They're there just for us to keep an eye on. Looking at breadth, the advanced decline ratio, where we had been extreme negative after Friday, well, we bounced back up to a more neutral reading on Monday. Looking at our trend, The ADX continues to advance. The red line is on top, which is selling pressure. The green line continues to decline. That tells us of buying power. So based on this, we are in a downtrend. And then this little kind of skinny line next to the dark line, that's a 5-period exponential moving average. Not a simple moving average, an exponential moving average. Our Arun just shows when the red line is at the top, that means sellers are in control, and the green line are buyers, and they are declining. So when you compare the two with each other, it tells us that our oscillator is negative because it's below zero and declining. Intermediate term. There was a change with the long-term trend with decision point. They switched over to a long-term negative. On Friday, they had switched to long-term negative with their PMO. So it's not looking very good according to their indicators right now. Here's the rate of change going back 10 periods. We're extreme negative and could be turning up. 20 periods, extreme negative. The Fibonacci, we fell down below the 61.8, but we came right back to that level. Standard deviation just shows that we're still getting a little far away from the standard price. Sean trend meter. The reason I bring this up is it's also giving us an extreme negative reading. The Swinland trading oscillator. This is the one that's actually the very short list of positives where it's been bouncing the last couple of days. Here's the PMOs that are rising, extreme negative and starting to turn up, where the percent of buy signals continues to decline and is negative, where those that are above zero continues to decline. The Chaikin oscillator also here is turning up slightly. Here's the boom indicator. This is what I wanted to point out on the 50 period. That's this top one, where we are extreme negative right now. We still have quite a ways to go based on the 200, and that's longer term. So this is short to intermediate term on the top. Our different trading systems, the Elder Impulse based on the S&P 500 went back to neutral. Also based on the SPY. The SAR system continues to be negative. The Qs are back to neutral. Now, long term, we're below the long-term moving average here, so our long-term trend continues to be negative. Then looking at the broad market, here's the diamonds, and these are a little bit out of order, where we're still negative, according to the Dow. Then the dollar, it had a down day on Friday, but it was up pretty strong again on Monday. And then this is what we're keeping an eye on. We're seeing at the very top, the Japanese yen and the euro in the middle declining, where the dollar is really advancing. Oil closed at just a little over 105. Here's another thing that Bank of America came out with, is what do they think gold is going to do in the future? And that's the gold line here. See, there's a little bit of common sense there. And this is the forecast. They think that gold is going to go up. We're right around the 1900 level right now. They think it's going to fall back a little bit and then eventually go higher. Take that for what it's worth. As far as bonds, we're seeing a continuation of a decline in bond prices. And here's the 10 to the 5 inverted yield curve. Here's another look at U.S. yields, and just to see how they've been really advancing pretty much across the board. Here are world rates, and the red line is what I'm paying attention to because of Japan and their 10-year bond. And then the next area are the potential scenarios that could be developing. I just mentioned those a little while ago. Here's some charts just to show you what I'm looking at. Here's the Coppet curve, and we're waiting for it to turn up. It's not doing that yet. So we're just watching this day by day. The mass index, it's not generating a signal yet. It needs to get above 27 for the first part of the signal and then drop down to 26.5 to generate both parts of that signal. That's not happening yet. The Pring bottom fisher, it looked like these were getting kind of close to crossing, but it's now turned down a little bit further. Then the staples to the S&P 500 ratio, did we spike now? This ratio did decline on Monday, but we don't really know yet. We're still above the moving average, and I did plot a 10-period moving average on here to kind of give us some idea whether we're above or below. And that's why you see the question mark right there. But in the past, when these have spiked, that has marked a significant bottom in the S&P. Just like this, when the 2-year Treasury yield spikes, that has often marked a short-term bottom in the S&P. A lot of times, the bounce that we get from that doesn't last very long, but it could be something that you could take advantage of. But we don't know right now if this is spiked or not. The other thing is when we see a little bit of a thrust up, and this is what I'm talking about that happened in March. And it's kind of hard to see because this is a long-term chart. But we bounced up with the small cap ratio right here. And then right after that was when we saw the S&P really start to bounce higher. We're waiting to see if something like that can happen now. But we're not really seeing that yet. We want to see this give us a bit of a breakout. So what's our outlook then for Tuesday? The technicals are negative. They're bouncing, at least on Monday, from an oversold condition. Can it continue is the big thing. The markets are still in this trendless intermediate term range that we've been bouncing around in for the whole year. The growth and value battle continues. The economic reports coming out Tuesday are factory orders and the JOLTS job openings report. Geopolitical events, Russia, Ukraine, a lot of crazy, scary things happening there. We'll have to see how that influences the markets. It's in everybody's mind, and it's what people are talking about and what they're concerned about, but we look at it here for how is it going to impact the markets. The whole supply chain issue, and I actually have witnessed this a couple of times. I teach English to children from China, and I'm doing a lesson online using video, and I hear this talking in the background, and I'm like, what's that noise behind you? And it's like, well, it's a drone outside our house telling us we can't leave right now. So that's kind of a freaky thing. Not as freaky for me. It's really freaky for them. And then inflation and interest rates, they continue to dominate, and that's what will really dominate this week is probably the Fed meeting. Oil, it could get all crazy again and start influencing the market. Earnings as they come out. We've got a lot of Fed speak that's going to be happening, especially on Wednesday, and then the whole situation in Japan that may be developing into something negative, but a little more long-term, but could then eventually bleed over into the U.S. So what are our scenarios? I don't have the whole list here because I kind of already went through those. We're in a downtrend right now, and so what's going to make things continue to go down? Rising interest rates and inflation fears. Earnings that spook the market, anything that comes out from the Fed either before or after Wednesday, they'll have to stop talking on Tuesday because they're locked up in a meeting. It's not likely that anything will spook the markets unless something medical happens. The technicals are negative, but they remain short-term oversold, and we're potentially bouncing up out of that. Are we going to get more of a bounce? For things to go up from here, we are coming out of an oversold situation. The possible positive scenarios that I went through, those might develop at some point and actually turn things to more positive. The technicals, they're really negative right now, but we might use some support resistance. We found that long-term support, and we're able to bounce up off of that on Monday. There are pivot points that we may get some bouncing from. The moving averages aren't going to really help us now because we're below all of them right now. And then another thing is, I haven't heard anybody say this, but I'm sure somebody has, where usually before an earnings report, if a stock really goes up like Apple, Amazon, Google, and it's going higher and higher and higher, and then the report comes out and it's great news and it should go even higher, and then it just tanks. Well, the opposite of that can also happen. Is there a possibility that they're selling the rumor? That's what this downturn has been over the last week and a half or so. And then once the Fed comes out and says, yes, we've raised interest rates another 50 basis points, and the market goes, phew, okay, that's behind us. Now we can move on. Let's send this puppy higher. I'm not saying that's what will happen, but that is a common tactic that is used. It's like they raised interest rates today and the market rallied 4%. I mean, or it could tank. I don't know, but this is just something to be aware of. And then sideways, we're not in that scenario right now with the ADX being above 20 and it's still climbing. So unless it drops below 20 and it drops below the moving average, that really isn't a viable scenario right now. So what's our conclusion? The S&P is negative. Short term, negative, and so far we can say it's bounced from being oversold. Intermediate term is negative and oversold. And then long term, we are negative because we're below the 200-day simple moving average. So thank you very much. I'm doing some changes to the blog where I'm going to be posting not only the charts that you just saw, but I'll also be posting the charts that you don't see, but I want to wait and tell you about that until after I successfully do it. So have a great Tuesday, and I'll prepare the next video after Tuesday's close.